Thank you for tuning into the All Funds Investment Podcast. This market update video is with Susan Barretto, editor of Alternatives Watch. She's a good friend of the podcast, and for those that are not familiar with Alternatives Watch, it's a daily news platform covering alternative investments geared toward institutional investors. She has a lot of great insights in the market. Check out the links for Alternative Watch in the description below. In this episode, Susan gives us a market update on alternatives in pension funds. We discuss the recently announced private fund advisor rules, and we get into the latest on managers and service providers in the industry. Just a reminder here that nothing said is legal, tax, or investment advice. Check out the disclaimer below. We hope you enjoy this conversation. Please like and subscribe if you find this information helpful, and check out the links in the description to connect with us and Susan. So what's going on in the alternatives world these days, Susan?
Oh, there's a lot going on. We had a busy week last week, and it's been a busy summer. If anyone went to the beach, I'd like to hear more, but we haven't. I will tell you, I kind of have tentatively nicknamed our conversation the state of play, and it's kind of a double play on words there because I thought it might be a good time to talk about the state of play with the state public pension fund systems. Obviously there's been a lot going on, a lot of money flowing into the space. I was just kind of looking at some stats here, and I'm happy to share them with you if you're interested. And I can add some stats of our own.
That'd be great.
Well, first off, I don't know if you've heard of a consultant called Cliffwater, but basically they always do kind of this research on at the end of every fiscal year on the state of public pension funds themselves and state public pension funds, sorry. And what they discovered was, and this is as of year-end 2022, so June 30th, 2022, that basically alternative investments have been up 10% over the last 5 years. So that's actual investment by these plans. And there's a shift to private alternatives allocations that kind of spans all investor groups, but definitely with the state public pension plans, there's been a lot, and that is a $3 trillion market. So they estimate roughly 41% of these assets are allocated to alternatives. So that's private equity, hedge funds, credit, real estate, the likely suspects. And I think they're onto something for many reasons, because we cover, as you're well aware, we cover a lot of the mandates that come out. And it's usually anywhere from 10 to $12 billion that we'll see in money moving in any given 4-week period. Now, I just did a quick tally through mid-year of this year. We already have about 95 billion from this group. And just to put that in perspective, all of last year, I think we were at roughly like 128 billion. So we could be at 200 billion by year end. And I'll tell you why I think that might be the case here in a bit. But just that's kind of where we're at in the state of play.
So let's unpack that. So you're saying this year we've already seen over $95 billion invested from these private pension funds into the private asset class?
From public pension funds into these asset classes. And that's just rough back of the envelope stuff. We don't necessarily cover everything, but we cover a good part of the market. And so I would think that this means, hey, returns must be looking really good. They have money to play with. That whole, denominator effect didn't happen, but there's something more going on. Basically, we are seeing that their actuarial assumptions, which they lowered during the pandemic, and that's essentially the figure that they need return-wise in any given year to make sure that they can keep paying out their pensions to retirees. So that's roughly 6.5% to 7%. So now we are looking at returns that are coming in at 5%, maybe 6%.
In terms of like being underfunded, is that going to be a problem? I mean, we've definitely seen some municipalities. I've seen from like Chicago. I know they've been, from where Chicago's been heavily underwater.
From time immemorial. We could say this in Chicago.
Right.
Yeah, no, and that's always been. I think the worst funded at one time was the CTA pension funds, and that was 40%. That was pretty abysmal. But yeah, so yeah, it's fascinating because you would think that, okay, in some instances in 2022, private equity was up double digits. I mean, this was huge and there's huge influx. But you can really tell when you dive into some of these larger state pension plans. There's one north of the border, I'll just say it that way, that has over 100% funded right now. They're throwing money into private equity and private debt because they can take a little bit more risk. But some of these groups that are less funded, they can't afford to take that kind of risk. So they have maybe put in, just a few percentage, maybe like 100 million, 200 million here and there at a time.
Mm-hmm.
And some are getting more aggressive with that because now they feel that they might be missing out. There's a little FOMO going on. So, just some examples of just returns, just off the cuff here, just recent plans that we've covered. San Mateo County employees out in California is one. They had a
Mm-hmm.
5.6% annualized return. And sadly,
Okay.
they do a lot in private equity. A lot of the California plans sort of mirror each other, and they're very active in private equity and real estate, particularly in real estate. They were kind of ahead of the curve of that. But PE was down, their PE portfolio over that time frame. This is year end, June 30th, 2023, was down 6.4%. So that's not helping. Virginia retirement system, which is, if memory serves, pretty well funded. So they've been very active in the hedge fund space over the years, particularly as well as private equity and credit. They had a return of 6.1% for the year. They have their overall annualized return assumption is 6.75%. So that's below their return assumption. Now they have time to make it up. It's usually smoothed out over a 3 to 5 year time frame. So it's not doom and gloom, but it's not good. Credit strategies in that program returned 5.7%, which is good, but it's still a little below average, what you would expect to see. And then real assets, which may be some real estate, infrastructure, natural resources investments, that only returned 1.7%. And then private equity was kind of a drag on the portfolio overall, as it was down 0.7% over that same time period. So that's rough. So then, if you go to roughly about the same size pension plan, Massachusetts, I looked theirs up the other day. They were up 5.6% net for June 30th, 2023. So they underperformed their benchmark by 3.3%. And a lot of that was from private equity and real estate. And a lot of these groups at the same time have also clawed back some of their hedge fund investments in favor of private equity and real estate. So who knows whether that's a great call, but it's created a really rough benchmark mismatch this year, and some of them changed their benchmarks as a result of some of this. But yeah, so hopefully over time this reverses, but this has been a rough year because the last half of 2022, a lot of private equity portfolios had to take the hit finally after putting it off.
Yeah.
Right. Yeah, that's interesting, Susan. I guess that benchmark mismatch that you mentioned, is that a common occurrence that you see over time?
It's beginning to be. It's been troubling. I mean, a few years ago, there was a big move to everyone saying, well, we're going to put the benchmark high at 7% for the overall portfolio. In fact, some of them were even flirting with 8. And now all of a sudden it's come back down again. And how that works out in the long run, it's hard to tell, but it's not a great sign because you want to be showing your retirees, future retirees, that you can be trusted with their money and do what you say you're going to do. So it's troubling.
Yeah. In terms of treasuries, has there been any issues with like treasuries in terms of these pension funds?
A lot of them don't really have a huge exposure to treasuries. It's not like the banks where they're required to hold assets that are less risky. Usually, they're cash portfolios, which will be anything like 1 to 2% the most. But interestingly, you bring that up because the other part of this is too that some of these folks have had overlays on their portfolios, and some of them have not necessarily done that well. Say like an S&P overlay or what have you, but the Treasury, you know, fascinatingly enough, in Illinois, where I'm sitting, there used to be a big market with the pension obligation bonds because we were trying to catch up and we were trying to, attract, you know, generally individual investors who were looking for investments that were tax exempt. You haven't heard a lot of that activity lately. There's been some rollover, I think, in Connecticut, for instance, but um, that'll be something to watch. I mean, with higher interest rates, I don't think municipalities will want to go out there and raise too much debt to make these obligations if they have to.
Yeah, it makes sense. Susan, you mentioned the specific examples like San Mateo County. Was the other one Virginia? You said
Virginia
retirement.
retirement system, and then Mass Prim, which is the state pension system.
Yeah. Can you shed some light on the factors contributing to the specific performance metrics, especially in the private equity
Oh,
domain?
so
Kind
yeah, I mean, so I don't have the actual benchmarks, but they tend to be blended, and there's some standard benchmark providers. But yeah, they had said that the benchmark is a 7-year annualized public market benchmark plus a 3% liquidity premium. And so that benchmark in that return period, and again, I'm sorry, I don't have the actual underlying public part
okay.
of that, but the benchmark return in that period was 14.4%. But the actual return, like we said, of the private equity portfolio was significantly less. And I think it was, sorry, I'm going from memory here. I believe it was 3.5%. So you kind of wonder, like, well, there's going to be some changes there, and obviously they're saying this is a long-term asset class. We're a long-term investor. We have 30 years. I mean, they can make these little changes here and there. What impact will that have on retiree pensions? It could have a serious one, because if they're not performing, and you're also locked up for a longer period of time in these funds, it could be a problem. But they're saying they kind of expect this. This is an anomaly that'll reverse over time. Well, markets are markets. They have their own ways of dealing with things, and it may not.
Right.
So, I don't foresee them pulling from private equity. In fact, they just put in. Let's see. They just put in some co-investments just this last month. I think it was like 200 and some $1 million. So they're not pulling, but at the same time, you have to wonder if they're going to hold some firms accountable.
Yeah, of course. Yeah, that should be interesting to see what happens. Like you
Yeah,
said,
yeah,
how this all plays out, and obviously, as you mentioned earlier, the trends. I mean, there's a lot of sounds like there's a lot of big moves toward the private alternative investment space. How does that compare to the broader investment landscape? I mean, things are happening. I'm just curious your
yeah. I
thoughts
mean,
there.
really, the story in institutional investment for the last 5 to 10 years has been one of growth in the private market space. I would say coming out of the pandemic, um, especially, or during the pandemic, even, there was this huge shift into private credit, which had started just prior to the pandemic. But there was this idea that, oh, there's going to be more distressed assets. There's going to be more need for more lending, and we've seen some of that. So that has happened. Traditionally, it's been at the expense now of traditional fixed income strategies, and even a number of traditional hedge fund players have been active in the private equity drawdown fund space to try to capture some of this. Um, so basically, that 11% figure I had, that's the private markets. So that's private equity, real estate, real assets, um, and debt. And then if you look at the more liquid parts of this, so this would be, liquid alternatives such as hedge funds, commodities, risk parity, risk mitigating assets. Some of those, like back in 2015, 2016, they were starting to see an uptick. Well, that's pretty much halted because that asset class actually fell by 1%. Now, again, these are figures according to Cliffwater. This is not from my particular research, but it lines up with everything that I'm seeing. And if that wasn't enough, we have the SEC's new private fund advisor rule, mucking it up a little bit more.
Oh yeah, that's exciting things happening all at once, right?
They never happen
Never a
in a
dull moment,
vacuum, do they?
one after another.
Yeah.
So there's a lot there you just mentioned. I mean, yeah, we can maybe kind of delve into a couple of those things, but I guess obviously the new private fund advisor rule. I'm sure you've had a few different conversations. How does it impact the relationship between the pension funds, the public pension funds, and the investors, and kind of the dynamics between the two? What do you see that kind
Well,
of playing out?
it's almost multifaceted because it's even more than just the pension funds directly with the managers. It's the pension
Right.
funds against each other because one law firm I talked to recently, they were talking about how some of the smaller allocators wanted to find out, and there is a keen interest on what the larger guys are paying and what deals they're doing with managers. So, just to back up, for people who aren't aware of this new rule, I should explain it. The private
Great.
fund advisor rule basically has a number of prohibitions on how the work of investment gets done between investors and managers. And so, one of the key ones is this whole prohibition on, um, I guess prohibition might be a strong word, but it's almost like a ban too, and that's almost even too strong a word too. But basically, it wants to do away this idea that some investors are getting deals that other investors aren't. So those deals might be a fee cut, or they get a shorter duration. They don't have to be in a fund for as long of a time, a longer lockup or something like that. There's a lot of different ways. There's also MFNs, or most favored nation status. So a lot of this was very prevalent in the hedge fund industry and kind of got some folks in trouble back in the early aughts, but continues on, and it's even prevalent in the rest of the private market space too. So basically, if you're a larger, say a CalPERS or a CalSTRS, you're not going to be paying the same fee for something, for the same service or the same access as a San Mateo County, let's just say. San Mateo may not even be able to get in the same fund that you CalPERS can get into because of your size and your scale. Well, the thing is, that's it's something that the SEC is concerned with because it's not giving everybody a fair handshake at all. So the what I call kind of the unintended consequences of this could be that the way that money is raised going forward is going to change dramatically. And one of the key things, I think this is why that 200 billion figure I'm pretty confident in, is I think you're going to see a lot of investors that are larger just double down and get into these funds that are raising capital right now and get their special deals in play before this rule becomes effective. And that's in the next 18 months. So, latter half of this year, traditionally it's kind of slow going into the end of the year. It could ramp up massively because once you have that locked in, that's grandfathered in. You can stick with that for the life of that vintage.
Mm-hmm.
So, going forward, 18 months from now, whatever's raised at that point, everybody has to be paying the same amount. Everyone is on the level. Now, I have even
Okay.
seen that there was one pension fund CIO I noticed on social media was asking for attorneys to help out, and so they could review some of the side letter agreements they have. So that tells you there's some real panic happening.
Yeah, well, that's interesting. Yeah, I mean, just thinking about how that plays out going forward. So, I guess going forward in the future, once this rule kind of is solidified, if you will, they'll
Implemented,
have
yeah.
to send that out ahead of the admitting investors into the fund, right? So they'll disclose that beforehand.
There's going to
Um,
have to be disclosure. And
right.
so there's a lot of extra disclosure that's on the part of fund managers. So that makes it hard too, because here they're going to have to pay more just to do business. And then they
Right.
are going to be having a hard time to charge that on to the investors. Um, it's a tough move. And I think to some degree for people like myself, maybe you guys might think this as well. I mean, if this is how the industry's operated for 30, 40 years, why change it now?
Yeah.
It's kind of a hard thing to, and I mean, like, pick the worst possible time. Performance
Yeah.
isn't doing so
And I mean,
great.
In terms of like effects, is this, I guess like are typically our managers offering better deals to like these larger institutions to try to get them in the door?
Yeah, because once you have one large institution in the door, the rest of them line up. And you'll hear it sometimes in these trustee meetings when they are public and live online. There'll be this hesitation. They'll say, well, we'll get 150 million in the fund and this is our commitment, but we'll just say up to, because we're not sure if we'll be able to get in there at the right point in time before they close the fund. I mean, some of these fund closures in 2022 especially, they were happening within 4 months, and historically these would be 2 years. So that shows you how rapidly the money was moving. So I'm gonna be a busy person. I hope we can do another one of these podcasts, but I may I may be typing away as we do them. I don't know. There's just a lot
Yeah,
going on.
yeah, I think we'll see a lot of different nuanced scenarios happen, right? Because I mean, there's a couple things. I mean, I haven't read the whole 660 pages of the
I haven't either.
ruling,
Yeah.
but I just kind of through the Cliff Notes version of a few things. One being the redemption rights that
Yeah.
state pensions normally have, right? And that kind of throws a bit of a wrench in the game there going forward. And then also the charging compliance activities towards the fund, and that will be some pushback there as to not getting compliance services in certain cases for fund managers, additional cost and what the fund can bear versus certain other arrangements that have been made. I mean,
And arguably, that should have been the management fee, right? I mean, that's what you'd say. And so, okay, so you charge that to the management fee. But yeah, there's a lot of detail that just has not been fleshed out. I don't that and I'll tell you, usually when a rule comes up like that, there was a whole week leading up where every law firm would be pinging us journalists saying, hey, we'll comment, just let us know. So I had a whole bunch lined up for interviews that went last Wednesday, when the rule was voted on, and it was crickets after that, which told me what I need to know, that this is a lot more complex than a few sound bites will ever cover, and what its impact will be decades.
Right.
Maybe.
So I guess there's a couple things there too, Susan. If you could remind us, I don't know if you've kind of went through the steps in the past, but recently. But just as far as like the AUM level of the funds, are there certain funds exempt from this?
Yeah.
This new
So if you're a registered fund, you are beholden to this new rule. But if you are not registered, this doesn't apply to you. But I'm always, I have to say, I'm not even up to date with this. It used to be like 100 million was the cutoff.
Right.
Maybe 120. Either way, these aren't the funds that institutions would be investing in generally anyway. But that brings up another point, I think, Skylar, and maybe we can talk about this at a later date when I have more info. But what does this mean for emerging managers? Because usually if you're seeding a manager, you get a special preferential deal.
Right.
And once the manager gets to say 500 million and they're registered, does that mean they have to give that same deal to all the investors that come after? I don't know. I'm just asking these questions. I'm not really sure and will that, gum up the works for seeders, because they were kind of having a tough time as it was.
100%. The capital raise process, what does it look like going forward now, given that, everything is out in the open? You can argue, the larger allocation, the risk reward scenario, and they're putting in more money into the fund. Should they be able to negotiate a better deal for that, right? Versus someone who comes in at a smaller allocation with a standard, and that's where you see some, even like, outside of side letters, share allocation, separate share classes, given different fee economics there in certain cases. Yeah. So there's a lot of different, I think, pieces to the puzzle here that will be impacted going forward downstream. Obviously, operational costs and things to monitor and report things that need to have a certain schedule to them going forward. Will all add to the equation of what this looks like. So yeah, will it hurt the emerging manager? I mean, it sounds like it probably will.
And I think the idea with this, and I think Chairman Gensler said this time and time again, was leveling the playing field. For whom? I'm just wondering to myself, because if this is leveling the playing field, is this going to help performance for these investors, or is it going to hurt it? Because fees are a big part. The numbers I just read off, that's net of fees. So if fees go up as a result, I don't know if that's helping the retirees, the future retirees, in a lot of
Yeah.
these plans.
Yeah.
It seems like another just kind of poorly thought out, uh, you know, legal structure here for creating these kind of now twisted incentives.
And I think there's a lot of political pressure, too, that they have to deal with at the SEC. And let's be honest, no one wants to have another Madoff type situation to deal with. But you don't want to have force a part of the industry not to be registered as a result of this either, or maybe creating other types of fund structures that somehow are under the radar. I mean, there's a danger to that too. So it's a tough one. There's no easy answers to this, but definitely we're watching here at Alternatives Watch. We're trying to give people a good 360-degree view from both the manager perspective and the investor perspective. Easier said than done. Maybe I will perfect cloning by the time we have our next podcast.
Absolutely.
Any news on in terms of the manager news? Any updates on the manager side that you've seen notable?
Well, we have seen that, unsurprisingly, the larger firms keep getting larger. Remember, Blackstone last month was talking about hitting 1 trillion. Ding, 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 ring the bell. So those large firms really have ramped up growth significantly. But one of the areas we're really watching is the growth isn't necessarily just on the private equity front. It's really that credit section. And that is really key to watch, because even if you're a capital markets person, it's key to know that credit bit is growing, because that feeds into the private equity space. Those sponsored backed companies are getting backed by, private credit. And then on top of that, you have a lot more interest and growth happening on the insurance asset side. So with Apollo, with its Athene deal, these are things that we're watching in the coming months to see how those come to fruition too. But yeah, definitely we are seeing a lot of ramped up growth in the space. Now that we have our compendiums, our annual compendium, we can kind of look at the larger trend and see what's there. I believe it was 740 billion last year through the end of March that we tracked in terms of fund closes and asset raising. So will that figure be the same going forward? It could be more. So
Yeah, it's pretty fascinating to see kind of what all the different elements and kind of converging in a few different ways here.
and that's not even including crypto, guys. Let's see how that all plays out too. I know you're interested. So am I.
There.
Absolutely.
Anything notable on the service provider side?
Oh, let's see. Well, there have been some acquisitions on the fund administration side. I'm totally blanking on all the names, but we have seen a lot of hiring going on in that space, particularly like fund administration and accounting firms. Um, yeah, I think that they have kind of benefited from some of the ongoing growth, obviously, in the industry. There is also just some questioning, though, in terms of if law firms will be shifting less from the fund launch side of things to more the compliance side. I imagine there'll be a lot more compliance guys getting hired going forward. But there's going to be interest in alternatives. It's just going to ramp up, I believe, and it's something that is interesting to watch from my standpoint as both a taxpayer and a reporter. And it's fascinating to see how money moves. And we have just seen so much money move in the last 6 months to a year into this space, into such a variety of strategies. It's hard to know how it will all play out in the end, but that's what I do. That's why I do it.
Yeah. Of course, I guess from your, obviously there's a few things here, but from your perspective, has this helped the alternative landscape of adoption, or is some of this kind of been a bit of a bottleneck as we go forward? I mean, I'm sure it could be a bit of both, of course, but
You mean with the rule changes and everything?
yeah,
Yeah, I think it could be a little bit of both. There's this element that is kind of been swept under the rug a little bit, but it's that whole retail element to this. And I kind of almost feel that this private fund advisor rule it really does have a retail spin to it in terms of, hey, what you see is what you get. You're going to buy into this, and here are the level playing rules. It could end up sparking a boom with respect to retail offered products, I think. Because if you've already if you've already launched one interval fund, maybe you launch some more. There's a lot of RIAs that are really scrambling to get in this space right now because their clients are asking why they don't have access to this. Hey, I keep reading about this in the papers. What's going on?
Right.
But I think there is some of that, and it could be a bottleneck as well. It could slow down growth in some of the risk asset areas. But then again, the market could surprise us. I know risk assets aren't very popular when it's high inflation situations, or I should say high interest rates. But all of this can change on a dime. And the global macro people say, yay, once again, come January.
Yeah, a lot of great points there. Yeah, I guess we'll just see how it plays out. And to your point about the alternative, the retail side of things, access has always been a challenge, right, for the alternative space when it comes to retail. And yeah, that'd be interesting to see kind of that the floodgates open from a retail perspective to see how that
Yeah.
changes things going forward for sure.
And I think technology has played a huge role. Chat GPT and all that aside, I mean, technology is playing a huge, huge role in this. And maybe that's some of the reasoning for this rule is just, hey, let's get ahead of this before things really get out of hand. I don't know.
Yeah, and to your point about compliance, more the law firms shifting to more of that compliance element. Obviously, some of this additional work, whatever it looks like, getting pushed to other service providers, maybe admins, accounting firms, right? Things like that. That would definitely increase their their workload infrastructure, and they're hiring more personnel as well going forward as a result of that too. Most
Yeah.
likely.
Now, this is stuff that technology can't fix. You just need actual humans to take care of this because
Yeah,
it's really quite. Yeah, I mean, it's going to take some time to parse all this out. But then again, that's why they have this 12 to 18-month time frame to let people get used to the idea. So there's going to be a lot of give and take, I think, and a lot of discussion in various webinars, and I'll sit in on them, and hopefully I'll see you guys too.
yeah, for sure. Well, this has been
Yeah.
great. Any, I guess one last question. I just in general, as you've seen, you've talked to a lot of people, Susan, as you know, that just what you've seen in the space. Is there anything that was surprising to you, or I guess as far as from an asset class perspective, where the trends are going with various pension plans and allocators, and to certain types of maybe some surprising findings that you've seen or correlations that.
Well, I would say one thing I find surprising, given all the kerfuffle we had with the Blackstone REIT earlier in the year, we've seen a lot of movement in real estate. And then coupling that, here's the interesting wrinkle, and I don't have numbers in front of me to back this up, but I've
Sure.
just anecdotally, a lot of debt portfolios or credit portfolios have been moving into real estate credit. So that's an
Interesting.
interesting one to watch, I think, for sure.
Very, very interesting side of things. The real estate market right now, especially with all the corporate office buildings and whatnot.
Yep.
A little bit of a rut right now.
Who knows where the office will be next time we talk? It's really something. I mean, yeah, major urban centers have been challenged for sure. But yeah, there's just been so much going on in multifamily in particular, and not just the Sun Belt.
Yeah.
And I see you smiling. You know what I'm talking about.
Well, Susan, this has been great. Where could people go to connect with you and learn more about Alternatives
Yeah.
Watch?
No, definitely come visit us. It's alternativeswatch.com. And, there's free access through our free newsletter. But also, if you care to subscribe, we are a lean, mean $300 a year. And for that, you get all this data I've been talking about, the compendium data and this manager and investor scorecards. So you kind of get to be in the know and behind the scenes along with me. So it's fun. And you can feel free to connect with me on LinkedIn as well.
We'll
Awesome.
include all the links in the show notes.
That's
All right.
right.
Thank you so much, Susan. We hope you enjoyed this conversation. If you're still watching, make sure to like and subscribe for more content like this. Reach out if you're interested in starting a fund, whether it's a hedge fund, VC fund, whatever type of fund that you're thinking about. And let us know if there's any topics that you'd like for us to cover. Thanks for watching.